How long do you spend picking out clothes each morning? Probably longer than most investors spend doing the math for real estate investment analysis. Unfortunately, people choose deals based on intuition, not analytics. Digging into the details of deal analysis might feel like a trip to jargon-town. Cap rate, NOI, cash-on-cash return, total return? There's more to choosing an investment property than its purchase price and potential rents. Investors have developed a library of ratios and calculations to minimize risk and maximize profit to help them invest wisely. Savvy investors learn these real estate investing metrics inside and out to evaluate a potential investment in minutes and monitor their existing properties. So, whether you're a new investor or one with 20 years of experience who needs a refresher, these are the top 10 ways to analyze a rental property for sale. Before we begin, be sure to like the video, hit the subscribe button, and turn on the notification bell for more interesting videos. Interestingly, the methods for analyzing the value of a real estate investment are analogous to those used in the fundamental analysis of stocks. Because real estate investment is typically not a short-term trade, analyzing the cash flow and the subsequent rate of return is critical to achieving the goal of making profitable investments. To profit, investors must know how to value real estate, make educated guesses about how much profit each will make, whether through property appreciation, rental income, or both. Accurate real estate valuations can help investors make better decisions when it comes to buying and selling properties. Let's take a look at these analysis methods. Number 10. Calculating net operating income. One of the cornerstone metrics of your financial analysis is the net operating income, NOI. This determines the property's total income after all expenses, not including debt service costs or your loan costs. In mathematical terms, NOI equals the total income of the property minus the total expenses of the property. NOI equals income minus expenses. NOI doesn't give you the whole picture or even enough information to make any decisions. Instead, it's the basis for calculating most of the critical metrics in our analysis. But you might have been wondering, why doesn't NOI include the expense cost of the loan, since that will ultimately affect your bottom line? That gets us to cash flow. Number 9. Cash flow. Cash flow is the money left over after all the bills have been paid. However, this simple definition gets a lot of people in trouble. You see, technically, cash flow is income minus expenses equals cash flow. But income may include more than just the rent, and expenses will consist of more than just the mortgage. You might say, the mortgage is $800 per month, and the property will rent for $1,000 per month, so my cash flow is $200 per month. False. Other expenses include taxes, insurance, vacancy, repairs, capital expenditures, water, sewer, garbage, gas, electricity, and more. Unlike NOI, cash flow includes your debt service under expenses. You don't have debt service in the NOI calculation because NOI dictates how much income the property produces, independent of the owner's financing. As might now be apparent, cash flow is your total annual profit. The higher your loan payments, the smaller your cash flow. If you pay cash for your property, your cash flow is the NOI as it's the property's maximum cash flow. Number 8. Rate of return. Cash flow isn't the only important factor in real estate analysis. You must also consider the rate of return, also known as return on investment or ROI. ROI is your cash flow relative to the cost of your investment, or your basis. Mathematically, that would be ROI equals cash flow over investment basis. So, what is a reasonable ROI? Let's compare other investing vehicles. High-interest savings accounts often have an ROI or interest rate of between 2 and 5%. A certificate of deposit, CD, sports, or ROI of about 5%. The stock market has an average ROI of about 8 to 10%. Number 7. Capitalization rate or cap rate. Just like NOI is completely independent of financing costs, the cap rate is a neutral figure independent of the buyer or their financing. It's calculated as follows. Cap rate equals NOI over property price. Cap rate may be the most critical number in your real estate investment analysis. The cap rate is independent of the buyer and financing, making this calculation the purest indicator of the property's potential return. Here's another way to think about cap rate. It's the ROI you would receive if you paid all cash. The cap rate assumes the maximum investment amount, the property's total price. The good cap rate depends on where you're buying. Most areas, however, see maximum cap rates between 8 to 12%. Number 6. Cash-on-cash return, COC. Just like there are multiple income measures, NOI and cash flow, there are also various return measures. The cap rate is the rate of return independent of financing, and the cash-on-cash COC return is dependent on funding. It's directly related to the amount of cash you put down. If you put $100 into a savings account, you might receive $4 per year or 4% ROI. The COC would measure your return if you had instead put that $100 into the property. COC is calculated as follows. COC equals cash flow over investment basis. Everyone's ideal rate of return varies. However, if you're getting less than 10% return on a property, it's probably not worth your investment. Consider investing that cash in the stock market instead. Number 5. Total ROI. In addition to cash flow, there are several other critical financial considerations in your real estate investment analysis. Tax consequences. You may gain or lose money to taxes. Property appreciation. Because the real estate market is volatile, you may not be able to predict this. Equity accrued. And don't forget, your tenant's rents pays off the property. COC only considers cash flow's financial impact. Total ROI considers all the factors affecting your bottom line. It's calculated as follows, where total return contains all of the considerations above. Total ROI equals total return over investment basis. Number 4. Operating expense ratio, OER. A measure of profitability, the OER tells you how well you're controlling expenses relative to income, taking all operating expenses less depreciation and divide them by operating income to get your OER. It's one of the few ratios used by investors, including depreciation, which makes it more inclusive of the property costs. A lower OER reflects that you've minimized expenses relative to revenue. If your OER has been rising over time, it would indicate many issues. Perhaps annual rent increases haven't matched expense increases, or your management company isn't keeping up on routine maintenance, leading to more severe problems down the road. Calculating OER using specific expenses can help you narrow down the reasons for its rise and help you get it back under control. Number 3. LTV ratio. The loan-to-value ratio measures the amount of leverage on a particular asset. And LTV matters to buyers who finance their deals as it measures the amount you'll need to invest against the property's current fair market value. But LTV is also the best way to track the equity you hold in a property, not just for financing, but for the value of your portfolio and assets accounting for debt. For financing, most lenders will not finance up to 100% of a property's value. They want to leave equity in it to protect their investment. They express how much of the total purchase price they're willing to finance in a loan-to-value ratio. The difference between the percent a lender will finance and the property's total value is the amount of cash you'll have to put into the deal. Number 2. Occupancy rates. An unoccupied unit generates no income, but still costs you money. Many operating costs remain unchanged even if you have no tenants. Most investors track 2 historical occupancy rates to keep an eye on open units and lost income. The physical vacancy rate gives you the percent of your units vacant compared to the total units available. It's easy to calculate. Take the number of vacant units, multiply by 100, and divide the total number of units. This metric can be helpful on a property-by-property basis or across your entire portfolio. The economic vacancy rate looks at the amount of income you're missing out on when a unit is vacant. Add up rent lost during the vacancy period and divide by the total rent that would have been collected in a year to get what the vacancy cost you. Number 1. Gross income multiplier. The gross income multiplier approach is a comparative valuation method based on the underlying assumption that properties in the same area will be valued proportionally to the gross income they help generate. As the name implies, gross income is the total income before deducting any operating expenses. However, vacancy rates must be forecast to obtain an accurate gross income estimate. The gross income multiplier can be found using historical sales data, comparing property sales prices and dividing that value by the generated gross annual income produces the average multiplier for the region. This valuation approach is similar to using comparable transactions or multiples to value a stock. Many analysts will forecast a company's earnings and multiply its earnings per share (EPS) by the PE ratio of the industry. Real estate valuations can be conducted through similar measures. And that brings us to the end of this video. We hope you enjoyed the video and be sure to subscribe to our channel for more of our awesome content. And please give us a like and share the video. And don't forget to turn on the notification bell for timely updates of our new uploads. We value your feedback. Feel free to share your thoughts with us in the comment section down below. And I'll see you in the next video. Goodbye.